All right, so this will be the first module, the lecture portion for this. Um, as we go through this, because it is recorded, you are free to pause, of course, and look over slides. So with some of them that are more wordy, I'm just going to hit highlights and then continue on. Okay, so begin with, we're going to talk about the efficient market hypothesis. We're going to talk about some of the tests and then talk about behavioral finance and how that differs from the efficient market hypothesis. As we're going through here, some of the differences in what you've already come across with is what we would call conventional finance. This is where we assume prices will converge to what the intrinsic value should be, that people are going to allocate resources efficiently, the most efficiently possible, and that markets show that efficiency for information, right? So that stuff we'll get through. And then with behavioral finance, we start saying, look, what if investors aren't behaving rationally? Or what if there are things like the inability of the arbitrageurs, the people trying to do arbitrage, they're not able to do the actions that they want because the market's not as liquid or what have you. And so when we start talking about how people are irrational, the two ways we really focus on is that either they're not processing the information correctly. And often this is where people don't understand probabilities of things occurring. And they think that things, because there's two possible outcomes, it's equally likely either one, that type of thing. And then the other thing would be, even when given some sort of probability and we tell them directly what's going on, they may be inconsistent in what they're deciding. So that's just some of the issues that come up with behavioral finance. Now, as far as our ability to process information, one of the issues is that you have only so much time in the day, right? And so you have to use shortcuts. We call those heuristics, but to make decisions about what's going on. People are often overconfident. You can read about that. We tend to see patterns even when they're not there. And we tend to think that some things are representative, even if they're not. As far as some of the behavioral biases, framing, and this is like what you see before or after the choice. It can cause you to perceive it in a different way. You can try to avoid regret. This is like the fear of missing out, right? And so you that could cause you to do things that are irrational. And this is one example of that. This is known as prospect theory. So Kahneman and Tversky came up with this. If you go read Kahneman's book, Thinking Fast and Slow, he talks a lot about psychology and the structure of the brain. And that's what this is looking at. On the left, you see that curve where as your wealth is going up along the x-axis, your utility, this would be like your happiness, goes up as well. It doesn't go up in a straight line, so we get what we call diminishing return. So it takes more and more wealth to get a little bit happier, right? If you see on the right, though, where it says this is prospect theory, this is where you'll have people, I don't know if you ever follow sports, but you'll hear coaches sometimes say that they hate losing more than they love winning, right? And that's what prospect theory is kind of getting out, is small changes downward can actually cause this sort of loss. So it's not the amount of wealth that you have, but it's the amount of wealth you have compared to yourself yesterday, right? And so highs and lows can occur much more frequently because of fluctuations in your outcome. And another issue can also be, if there's limits to their ability to arbitrage things away. And the famous quote around this is by Lord Maynard Keynes, markets can remain irrational longer than you can remain solvent. So we can sit there and talk about how this price can't last and it must collapse. And actually wrote a paper about GameStop and the short position that they hold for over a year. And like that's an issue. Can the market stay out of balance? Can it stay mispriced longer than you can afford to just keep paying the fees to keep things open? And of course it can, right? Some other issues like implementation costs. So if it costs too much for you to do transactions, then you wouldn't be able to necessarily find that price, right? And then there's always the possibility that your market model is just wrong, right? And so the market is not going to behave the way you've modeled it. And so even though you're trying to get the price to converge to what your model says it should be, other people are using other models, and so they're working against you, and so it would prevent you from getting a convergence. Bubbles are something that obviously we talk a lot about in finance. You've heard about debt bubbles occurring. And normally what happens with a bubble is that because of government policy, you have a lot more capital available, and the returns start getting bigger and bigger, which attracts more capital. And as that happens, the market becomes overheated. And so eventually that bubble will either deflate or more likely pop, right? And so when that happens, it gets felt throughout the market. There's a couple of examples here: the dot-com bubble in '95 and housing in 2008. But if you want to look up something called tulip mania, this actually goes back to Isaac Newton. He actually invested in tulips, and so there was like a whole bubble that developed there as well. So these types of issues, come up. So when we talk about why there are these types of bubbles, right? We talk about the dividend discount model. This came up in some previous classes, where you just take the dividend that we're expecting to get and then discount that back at some percentage and then tell you what the value is today. And if you use an 8% discount rate, then we would have expected this 12 billion or 12.8 billion, right? But if the dividend growth rate was only 7.4, which was about what it was a couple of years later, then the value is only 8.5 billion, right? And so all of that difference in the value is really driven by that small difference in the dividend growth rate. And we don't know that that's steady, right? A lot of our models depend on those things being steady, and you see how such a small difference can make that change. Okay. Another piece to talk about is technical analysis. So technical analysis, fundamental analysis means you're looking at the fundamentals of the company. Technical analysis is when you are simply looking at some technological things that are happening. So I have a high, a low, a high, then that would show that, and then I expect the stock price to fall over the next day, or it fell and then it bounced up and then it fell again. And therefore I would expect it to remain stable over some time, those types of things. So you see patterns that develop, but you don't care what the underlying stock is. I don't care if it's 3M or Google or Disney or Hasbro, right? It could be any possible type of company. I'm simply looking at things which are happening within the market, because when people see certain things, they often behave certain way. And so these become sort of self-fulfilling prophecies, right? This is a bit about some bullish and bearish signals. Bulls, you can think of those as like, slow plodding animals, but they raise their head up to try to gore with their horn. So they go up, right? And when a bear attacks, they get up on their hind legs and they swipe down as they're falling, right? And so they're using their weight and gravity to make the attack stronger. So bullish signals are things going up. Bearish signals are things coming down, right? It's not so much as a good or bad sign. I mean, markets have ups and downs. It's just understanding when they're going to happen and properly positioning, you'll be okay in either type of market. And here's a bit more about some other technical analysis. And basically you're just looking at, how the returns are looking relative to the market or relative to the industry. It's what we call it relative strength. Another thing is like how wide the market is, the breadth of the market, right? And so this is something that gets put out, and they'll tell you what the volume looks like. And then you can see, how many are going up, how many are going down. So that's the advancing and declining, right? And that gives you a sense for, is the market generally going up or down? This is another one of those things that will tell you to invest or not invest in the market. And so this is that what's called trend statistic, where you're looking at the volume divided by the number. And it's just another one of those things it's not telling you what to do specifically with a stock. It's just telling you general sentiment. And then based on that, that, okay, I expect the market to generally go up or generally go down, but every stock will be different. But that'll tell me like sort of the current, for the flow, right? The fish will swim as they swim, but there's a current flowing in a particular direction. Here's another type of technical analysis to get a sentiment. They call this the confidence index. And really what you're trying to do is see, what do the yields look like for these really strong corporate bonds, right? And then what does the yield look like on these okay bonds, right? And you're saying how much of a gap there is between the best companies and some middle of the road companies, right? And you expect that always, the best companies are paying the lowest rates, right? So it's going to be below 1. But if they're really close and suddenly they're saying, that we're not seeing a lot of difference between really good and kind of okay companies, right? Which again tells you some sentiment. Short interest has to do with short stocks, and then the call and put ratio. You can look at how many options are outstanding, and so you can have a sense for how are people putting things in place to quickly sell, or are they putting things in place so they can buy in a hurry? And that'll let you know if people generally think it's going to go up or down. We've talked about the capital asset pricing model in a couple of different classes now, but just wanted to go over that again to remind you that what we're doing is comparing like to the market to say how different or how much variance do we have relative to the market, and what's this covariance, and then we call this beta. Right. And so the expected return on an investment is going to be equal to the risk-free rate plus beta times what we call the market risk premium, which is the difference between the expected return of the market and that risk-free rate. And as I said, beta is just the covariance with the market divided by the variance of the market, which is telling you what is that relationship between the two, right? And then based on that, assuming that you can borrow and lend at the risk-free rate, we can come up with a security characteristic line. We talked about the security market line as well. This one just has that EIT, which is, we're adding some noise in there as well. But the excess return that we're going to have in time t is the return on our investment at time t minus the risk-free at that time. And then we can decompose that into an alpha, and then we have a beta component, the market risk premium, and that noise. So we can do some regression analysis. We're not going to do a lot of regression in this class, but you do need to understand that that's really what we're doing, is we're trying to come up with what is the closest thing to a steady beta that we can use as we're creating this line. So these next few slides, I'm just going to kind of clip through them. I know you don't want me to read all this to you, But these are some different tests that people have done in trying to figure out how well does this really pretty model that we taught you, right? We did CAPM for a couple of different classes, and we've done security market line. But how does that fit with what happens in reality, right? And so here's a few slides on that. All right. And then here's just a couple of issues with beta, right? And so we can get errors in our beta because of the way we estimate this, right? And so we try to get better data, right? And since we have more of that, then we're able to construct what beta would fall within. And so you notice it says Fama and Macbeth, they worked on this a great deal. Here's an example where they were looking at different time periods and how these various things change. So if you notice, they say like average, it looks like a Y. I think it's lowercase gamma. But these are like decomposing beta into different components, right? And trying to see, how does that change over time, and so this is what they were trying to do was do some studies just to see how this holds, right? And so this was the what they got out of that. So we know that CAPM is not perfect, right? And so the reason we really test using that is it's a good introduction on how to think about decomposing the factors that go into stock returns and how to estimate what they should be in the future. Based on that, we've then augmented to things like multi-factor models. We'll talk about Fama French. But you can look at things that would drive growth. So here's a couple of papers looking at other category factors that their own results on other ways of changing that. Here's a little bit about Chen, Roll, and Ross. And then Fama French. So we talked about Fama Macbeth. This is the Fama French. And so they look at book value, book to market, so high to low. They look at low capitalization firms to high capitalization firms. And so based on these types of factors, then they have their own different types of beta, right? And then here's a couple of others that are based on risk. Liu and Veselov and Pekova and Zhang. And so again, these are just different ways of trying to come up with more tweaks on that same basic model, right? Of just a regression, alpha being at some sort of intercept, beta being the slope of this line. But are there better ways of calculating that? Now, some of the things that could further explain some errors, glamour firms, these would be things like Tesla. Tesla's this is currently 2022. And so Tesla's last I saw, they were larger than the next 20 auto manufacturers combined, right? And so there's really no reason for that from a asset standpoint for it to be nearly that high, but that's one of those glamour things because the CEO is a really good salesperson, right? And so like these types of things can happen in the market where people are not actually behaving as you would expect them to. And then another thing is just momentum, right? This is just how I was talking about having a current, the stream has a little bit of a current in it and it sort of pushes things. That sort of happens with stocks. You'll see stocks that just kind of keep going because they're going badly and people talk badly and they think it's going badly and it just gets worse. And then same thing for it doing well. So that's another issue. These are different things that people have tried to use, to try to figure out what would be the best way of predicting what the future value will be. Okay, and another issue that we're going to have to think about in this class is liquidity. And this is the ability for you to sell whatever it is. So normally with stocks and bonds, we think of these as being very liquid because we can go in and out of the market. But that's not true for all assets, not even true for all securities. And sometimes you have to have particular types of clients that you're allowed to sell to. Sometimes they're very high costs in the trade itself because they have to find another person. If you think about buying and selling real estate, there's a lot higher commission there than there is in buying and selling stock. So all of those things affect the price as well because that liquidity has to be priced. And so this is an example looking at that. And liquidity does get priced in the market, but that's another area that can cause what we consider to be mispricing because we may have different values for what the liquidity of it is. The equity premium puzzle is what we refer to. Why is it that the market risk premium is so high? It shouldn't be that high unless we assume very high levels of risk aversion, and people just do not act that risk averse normally, right? And so a lot of this is, there may be some other factors there. A lot of times what it is misunderstanding risk. And that's how that shows up. Survivorship bias is another issue we have where we don't think of the hundreds of firms that have failed, only the 3 that have survived, and we assume that other firms are like those. But they did not. And so we should, that's an issue. Here's the same thing with illiquidity premium is a big deal. We talked about liquidity and what that is. So that's, the issues around that. Here are some examples, some other papers. Barbaras and Wang looked at some things that could cause you to behave irrationally. And so a lot of this is looking at ways of explaining investor behavior when it seems to be simply irrational. All right, so that's the first module. I hope that answers your questions, and I look forward to seeing you guys in module 2. Thank you.